a rather disconcerting fact, which is that John actually got his CFA before I did. And this is disconcerting because John and I have worked together beginning in, what was it, 97 or 98? And I always thought I was older.
Yeah.
98. I always thought I was an older guy than John, but I guess he was precocious and ahead of me on that. But and now I am still, of course, connected with the CFA Society, as we all are, globally. And now my daughter, who is an analyst in high yield at Fidelity Investments, is sitting for the CFA. And so I'm watching and living this entire process through her 25, 30 years later through her eyes, which is fascinating. Although she's working from home sometime in the same house where I am, and I did hear a whoop of celebration when it was announced that CFA 2 would be moved to December. So I'm still very much engaged in this process. It's great to have the chance to be speaking with you all today and take you through Neuberger Berman's current thoughts about the crisis that we find ourselves in. What we did as a firm in the midst of this crisis, really starting in mid-March, was work with the senior investors from across our platform. And as John said, we have 330 billion, over 600 investors across global stocks, bonds, currencies, commodities, liquid alternatives, and the breadth of private markets. And we're able to engage the senior investors, more than 20 portfolio managers across every component of global markets, as well as with our own research and key input from critical external experts, to do really two things. And Joe, if you flip forward to the next page, I can share the process we went through. We first had to define this crisis in the middle of the crisis. And as part of that process, we tasked ourselves with identifying the potential scenarios for the path through the crisis. And at the time, we came up with the ULNV or LUV framework that is naming this webcast. At the time, these terms weren't quite as generic as they have become now. But we did identify these paths. We decided we were going to put very specific data associated with projections on these paths, knowing that we would be wrong in detail, but wanting to be very clear about our expectations. And because we felt it was very, very important for us to have a framework for decision making through this, what was clearly going to be the most uncertain environment of our investment careers. As part of this process, we also unearthed a number of key themes, and these themes, we believe, represent a new investment regime. The first new investment regime really since the great financial crisis. And as Brad Tank, our head of fixed income, said at the time, usually you see new investment regimes through the rearview mirror. This time, we're seeing a new investment regime through the front windshield because of the rapidity of the onset of this new environment and the magnitude of the response. And we think there are some key themes here. And what I'll do is I'll go through the scenarios and update you in terms of where we stand on those scenarios. And then Joe McDonald will take you through some of those themes, and then I'll finish with translating that into how we're translating this into client portfolio. So first, some important foundational determinations. The first is that the pandemic we're experiencing is the greatest global growth shock, really, since the Great Depression. It is a growth shock, not a financial crisis. 08-09 was a financial crisis that led to a growth shock. This is a growth shock that has not yet led to a financial crisis, although it could, and it was close in early March. As a result of this growth shock, markets have experienced severe volatility, but it's been uneven across markets. Not all markets have reacted the same. And now we have fiscal and monetary policymakers taking extraordinary action, unprecedented action in terms of the rapidity and the size of the policy response to the crisis. And that's also creating winners and losers. So we have uneven outcomes associated with the initial volatility, and now winners and losers as a result, either intentionally or unintentionally, by policymaker actions. And that's creating a number of the themes and opportunities that we see out of this process. So with that, let's dig in on some of the facts, some of the projections. So we projected that we would see a peak in viral infections in the U.S. in the May-June timeframe, with Europe a couple weeks ahead. Clearly, China had already peaked, and this appears, the data now appear consistent with that forecast. And so, that was a foundational element of our base case at the time, and the path of the virus is consistent with that base case. Now, the magnitude of the stoppage of the economy has certainly been extraordinary. We've never seen, if you advance to the next slide, we've never seen an economic response to a short-term stimulus like what we've just seen. And we do a lot of big data work at Neuberger Berman. We have a dedicated data science team. And so here is some of the information associated with some of our big data work to try and get a sense of both the magnitude of the shock, but also now get a sense of the path of recovery. And so here's some information from our credit card data work, just showing, the depth of the decline. This is restaurant spending in the US, key metric of consumer behavior. And you can see whether it's first quintile earners, the lowest income earners, or fifth quintile earners, this just fell off a cliff. Now you see the recovery, and the interesting observation that lower earners are actually recovering more quickly now, probably from a lower previous level in terms of restaurant spending. On the next slide, we look at, we slice the data in another way. This is weekly Amazon spending. Here's the other side of the equation, and you can see, what happened and the spike in Amazon expenditures. Once again, you see divergence between the highest income and lowest income earners, where the highest income earners were initially increasing their spending on Amazon a lot more than the lowest income earners. That's now reverted, and this probably gives some evidence of this post-crisis world, that certain key relationships from prior to the crisis are likely to be different after the crisis. And in some cases, trends like the Amazonification of retail, which were in play before the crisis, are now amplified and magnified exponentially in the post-crisis environment. And this is one of the elements of our key themes through the crisis. So let's now dig in on scenarios. Now, we did this for the U.S., we did it for Europe, we did it for China, Japan, and globally. And as I said, we wanted to be very explicit. And so these are the forecasts, the scenarios that we put out in early April, and we're living with these numbers. So here's what we said. We thought the base case, bull case, and bear case, the U, V, and L-shaped paths through the virus crisis, would look like for the U.S. We expected, as I said, the virus to peak in May-June timeframe. We seem on track for that. We expected in the base case a 25 to 30% annualized contraction in GDP growth from peak at the end of 19 to trough at the end of the second quarter, and then a moderate rebound in the second half, leading to a 6% contraction in US GDP for the full year. This path was characterized by unemployment that spiked well over 15%. We've now updated that to over 20%, which is where we are. We expected this to be associated with 25 to 35% S&P earnings declines, 10 or so percent default rates, and we assigned a 65% probability to this base case. We created a bull case, what we call V-shape. That's also a sharp contraction, but a more robust recovery. This indicates, that the virus is brought under control. We don't have major second wave infections, and probably greater optimism and benefits from science, the benefits of social distancing, benefits of earlier.
Eric, I think you've gone.
Vaccines, although the earliest we think of, and this still leads to a contraction of 3% over this time period. Joe, just confirming you can still hear me.
Yes, you're back on.
Okay, great, thanks. Now we also identified a bear case time period, a more severe starting contraction, and then a much slower return to work, probably characterized by second wave infections, additional lockdowns. And in the bear case, we also contemplated significant financial stress on the system, knock-on effects, whether it's political concerns, political risk between peripheral and core Europe, and emerging market stress. And what is now interesting to us, nearly 2 months after we've published these views, is that the economic data and it has really been consistent with the base case, whether that's updated IMF forecasts that now show the US expected around 6% contraction for the year, manufacturing and PMI information, consumer spending, corporate earnings estimates and revisions, et cetera. This has now become, our base case has now not only been consistent with the data, but it really seems to be fairly consensus in terms of the potential path through the crisis. What is interesting is how markets have reacted. If you just look at the S&P 500 and US investment grade credit, you would think that markets are pricing in the V shape, given the rapidity of the bounce back of the S&P 500, up 35+% since the nadir on March 23rd. Investment grade credit spreads having gone very wide and tightened back in. That would appear that market participants are pricing a bull case. Now, when you actually disaggregate market activity, you notice that there are huge dispersions across markets. In the US, the Russell 1000 growth or the NASDAQ index are either at new highs or at positive levels for the year or close to positive levels for the year, whereas the Russell 2000 value index has a 30% spread, down 30% relative to the large cap growers. This has been that market participants, again, they love the tech and defensive and big growers, consumer staples before the crisis. And at least up until recently, they love them as much, if not more, afterwards. We're starting to see some rotation away from those big growers towards more value and cyclical areas of markets and the economy. That would be evidence of markets rotating towards our bull case. And we'll talk through kind of opportunities associated with each of these. The final observation I'll make on at least the US scenarios, but I think this is broadly true, is that the risks associated with the bear case are still largely in play. We still don't know how fast we can restart economies after this drawdown. We still don't have a true sense of the depth of the damage to the true economy. We still don't know if there are kind of bodies yet to float to the surface in the financial sector as a part of this. And we still are at risk of second wave infections or significant challenges in the third world. You see Brazil and India and Russia, where the epidemic is still increasing and largely is not yet checked. So it's interesting to us that the bear case is still there. So we met more recently with our asset allocation committee and really ratified this framework in terms of our scenarios for this process, even 2 months later. We turned to Europe, very similar set of views, but a little worse in terms of the base case, down more, and then a less robust recovery to an 8% year-over-year decline, really due to the larger exposure to global GDP growth, exports, less exposure to kind of the technology and large grower space, and also less kind of fiscal and monetary policy bandwidth to address the issues. We're now starting to see important movements with the announcement this morning of a bigger proposed kind of emergency program than what was expected. But it's here we are in late May, and we're just now getting to some of these programs in Europe where these have been implemented in the US and in the UK and Japan and China, et cetera. So we provide a lot of data. This is the kind of the background behind each of the scenarios in terms of what our expectations are. I've shared what our expectations are. I've shared a number of these. Importantly, we have views we tie in monetary policy, fiscal policy, and significantly in the on the monetary side, our expectation is that the Fed remains at 0% for 2 years or potentially longer. It took them 7 years to raise rates above raise rates for the first time after the GFC. It could take as long as 5 years this time, perhaps, for the Fed to raise rates. Significant expansion of central bank balance sheets, and on the fiscal policy side, also significant fiscal policy expansion. And then we show kind of how on the bull case, what happens in terms of some of that support in the bear case, where you could see the Fed buying equity ETFs as the Bank of Japan is doing. You'll see an expansion of the Fed balance sheet, perhaps to 10 or 12 trillion dollars from the current expectation of 7 to 8 trillion. More fiscal stimulus, and there's talk now of kind of the next wave of fiscal stimulus in the U.S., which could be $1 to $3 trillion, all around that bear case. So as you move forward in the slides, we wanted to kind of share with you this important framework for the paths through the crisis. But regardless of which path we take, which of those scenarios we follow, or some variant, I didn't talk about a W or a Nike swoosh shaped path, we believe that the post-crisis world will be characterized by some critical themes. And I'm going to turn to Joe McDonnell to take you through those themes.
Great, thanks, Eric. I'm the new CFA holder on this. I've only had the CFA for 20 years, so I don't think, thanks very much. So essentially, yeah, we thought it was very important to think through themes which would be robust themes in terms of, we don't know which of the environments is likely to prevail. I mean, obviously, we favor the U-shaped recovery from here, but there's a possible tail case on the L shape, and there's a possible optimistic scenario in V shape. So we felt it was important to identify various themes which were consistent with the significant uncertainty that we have, and then think about how they would play out in different ways from an asset class and strategy perspective. So the first theme we identify is durable income and yield. Income and yield are not new in any shape or form themes, but durable is the operative word here, because we are going into a period of time where we're going to see some fairly uncomfortable things. We've seen it already, where European banks can no longer pay dividends. You see CFOs and CEOs not providing any future guidance on earnings. As Eric mentioned, we're going into a default part of the cycle. We're going to see probably defaults increase by a factor of 3 or 4 over the next couple of years. Who knows what about recovery rates? We're also, of course, seeing the trend for the last 20 years of sovereign debt yields falling consistently. We've now, in the space of 3 or 4 months, that's played out. We now have close to zero yields in many developed sovereign markets. So, thinking about where you can get durable income and yield is pretty important in this environment, particularly when volatility is high as well. So I'll come on to that. I'll talk that in a bit more detail in a second. The second theme here is regime shift in equities. The phrase regime shift is overused, but basically you need two things to see a regime shift. First of all, you need a step change in volatility. That could be up or that could be down. And you also need a step change in growth, up or down. So we're clearly now in a high vol negative growth environment, maybe migrating to a high but reducing vol to flat to slightly positive growth environment. So if you think about those UVL scenarios, we are still saying negative growth, regardless of even if it's a V-shaped recovery from here. So taking a step back from what's happened over the last 4 to 6 weeks, this is a difficult environment for equities, and I'll get into that in more detail. And I think there are a few things that you can do in terms of making changes in your portfolio to keep it more robust, given the fact that it is a high vol, low growth environment, and that's something we'll get into in a bit more detail in a second. Dislocation is another theme. Dislocation, every time a market corrects, you get a lot of private equity guys jumping up and down talking about this is dislocation, this is great opportunity. In actual fact, that's not always the case. So fourth quarter of 2018, we had an equity market correction, did not lead to wide sell dislocation in asset markets. Dislocation is about the underlying economy. It's about the depth and the duration of problems that happen in the underlying economy. So we're actually probably at the early stage of talking about dislocation than actually saying that this is necessarily a great opportunity for investors. Idiosyncratic ideas, it's very important in terms of building portfolios to think about uncorrelated strategies, to think about also contrarian strategies as well. So I'll address that as well in a few minutes. So quickly, just going into the first of these, durable income and yield. I mean, Eric mentioned, I mean, one of the things we can say about March, and Eric did mention this, is monetary authorities actually did a very good job. There was a few trading days, I think the second week of March, where equities sold off, credit spreads widened out, and treasuries sold off. That's not really supposed to happen. I think there's 3 or 4 trading days. The monetary authorities, the Fed, obviously starting this off, moved very quickly to underwrite those markets. So effectively introducing or reintroducing the primary dealer facility, buying $500 billion of treasuries, about $200 billion of mortgage-backed securities, announcing a program to buy IG bonds, and indeed it started that process a couple of weeks ago on ETFs. So essentially, what took perhaps 15, 18 months back in the financial crisis from a monetary perspective, getting to zero rates and making sure there was enough support for the markets, actually because of what happened in the financial crisis, there was, if you like, a playbook which the Fed and the Bank of England and the ECB were able to move on very quickly. So we should say, whether this is a great thing in the long run or not, having, the amount of financial repression we have on QE, but what we can say is that we're able to step in and provide confidence for the markets because of their activities. The second slide here, just the second diagram, is just showing that kind of fall, consistent fall over the last 15, 20 years in sovereign developed market yields. This is a trend that's been there, but it's obviously been emphasized and speeded up, if you like, over the last 3 or 4 months as well. So this is a concern. The reasons why investors like fixed income or long duration government bonds, if you like, I was a pension fund manager for a number of years. I'd buy them for liability purposes, buy them for potentially diversification purposes, buy them for income purposes. Income is not really part and parcel of what this huge market is about today. So we move on to well, what can you do on income and yield? And I'll relate this back specifically to the scenario analysis in terms of the shape of recovery. The best asset class, theoretically, is the asset class that you can see holds up well, regardless if it's a U, V, or L shape environment. Again, we don't know which will necessarily prevail over the next a year and a half. So if you think through that, in an L-shaped environment, where effectively we go back to work, we have reinfections, everyone then has to come back home, and we have problems, if you like, from a consumer perspective, and these real structural issues that you have a problem with there. Then in those instances, investors will probably focus on what the Fed buys. And the Fed is buying investment grade fixed income en masse. And you'll see this obviously in other monetary authorities as well. So if you like, that's providing a kind of a put option or down market protection on an asset class. And that's very important. Now, if you have a standard, if you're more of a U-shaped recovery and you think actually Q3 and Q4 are more constructive, then you might focus on what other institutional buyers would do. So as a pension fund manager, as I mentioned, for a number of years, I used to buy investment grade fixed income at much tighter spreads than what they are today. So in March, the spreads on IG were about 300 and 310 basis points. They've tightened in significantly over the last month, closer to 211 basis points, but that still offers a significant amount of value from a long-term investor perspective, like I mentioned, a defined benefit pension fund, for example. And so in a U-shaped recovery, you think about those sorts of institutional investors and what they're likely to do. And in a V-shaped recovery, obviously, the markets will respond positively. All boats rise together, so investment grade would tighten in. So this is why, and we've been talking about this for the last 5-6 weeks now, investment grade fixed income was and continues to be a very attractive space for investors to allocate capital and risk to. Within investment grade fixed income, and Eric used the point that we've had a massive growth shock. It's not a financial shock that leads to a growth shock. You could argue that banks in particular have improved their balance sheets over the last 10 years, particularly US banks. They may be part of the solution, less so of the problem this time around. So, the spreads that they're offering, given the fact that particularly diversified financials in the US, it's an attractive area. So we have a structural bias, if you like, or current bias, if you like, to financials. And as COVID plays out, if you feel L to U, but not overly positive on U, then it's about kind of utilities and farmers and defensive sectors. And if you feel U to V, either more progressive growth from here, then you can think about energy, materials, auto, and retail. Obviously, those sectors have suffered very significantly. So it's about always thinking about those scenarios in relation to sectors as well. As you move down in quality, so high yield. This is the area that's going to have the most pain over the next 18 months. Probably we'll see cumulative defaults, not the region of kind of 20-25% over the next couple of 2 to 3 years. You look at spreads today; they look attractive, 750 basis points. That's a typical spread you get in a high yield market in a recession. Obviously, this isn't necessarily a typical recession. They tightened in; they were close to 1,000 basis points 5 or 6 weeks ago. I think one of the things that investors need to be conscious of is bifurcation, which means essentially, while there are 20% of high yield issuers who are in real distress, 80% of issuers are not really in distress. So that 80% is trading much tighter than 700 basis points, closer to 500-600 basis points, while you have obviously that 20% of distress in energy and other sectors, which are, if you like, balancing out and giving the impression of a much higher spread. So it's actually quite difficult from an active perspective to capture the what you think is the prevailing yield in the market. And it's very important, obviously, to continue to look at the ratios, spread ratio of high yield to IG, as that moves around quite a bit, given the fact that we're pricing in U shape now, but as I said, if you shift to V shape, you're going to be more constructive potentially on high yield. EMD, obviously a very important space. Emerging market debt has also tightened in, probably more challenging. Eric mentioned COVID is less developed, but essentially, quite a concern in emerging markets, particularly we're talking about South America, Brazil. It looks better in Asia, obviously more advanced in terms of the curve of flattening and moving down. So China bonds is an asset class that's done fantastically well year to date. I think up about 5 or 6%. Low correlation to developed markets and low correlation to EMD more generally, but you have to look at EMD and think there's going to be a lot of stress potentially in that segment over the next 12 to 18 months. So we think there's going to be a lot of dispersion, and there's potentially a lot of countries which will have to restructure their finances. Obviously, going into this, they were obviously in a relatively weak position, and we have a global demand environment which isn't conducive to a lot of spread tightening here either. So EMD is a troublesome area potentially or challenging area for income and yield. Moving on to the second theme, regime shift in equities. So I mentioned how really this isn't a good environment for equity investing. So we have to take a step back from what's happened in the market over the last 5 or 6 weeks. Much of that was probably pushed by the level of monetary intervention, the level of fiscal intervention announced as well. Of course, we see more of it in EU more recently as well. So that's all positive, but ultimately, let's take a step back and think about what's happening or what's likely to occur in equity markets or the real economy over the next 12 or 18 months. Well, earnings are going to fall. They're obviously, as I said, CEOs and CFOs are providing no future guidance earnings. So we've seen a very significant fall in earnings from here. Dividends are not being paid, or I worked for Shell, a pension fund, for a number of years, and 2 weeks ago, for the first time since World War II, they cut their dividend, and they cut it by a factor of, I think, 3/4. So that's not great on a forward-looking basis. Buybacks, which have helped push certainly the S&P, but other markets potentially as well. That's not going to be happening going forward. Taxes, we don't talk about it now because obviously we're trying to deal with a crisis, but if you have very significant fiscal deficits, you can see both income and corporate taxes increasing in a 12 to 18 month horizon as well. So what you see on the left here is in a low growth environment, quality tends to do better. And that's proven to be the case thus far. But it is just generally quite a difficult environment to be overly excited about equity market returns. So the kind of four areas that we focus on, we think investors should focus on: quality. Quality, obviously, companies which have low leverage, have good financial flexibility, may have short-term cash flow issues, but ultimately have strong business franchises. If you believe an L shape, infection rates, reinfection rates may be high, we may have to change our behaviors more long-term, then quality becomes quite narrow. And as we've seen, you'd be talking about consumer staples, for example. Our view is actually more constructive. Investors should be thinking about quality across on a sector neutral basis. So thinking about, who are the market leaders in each sector, who are likely to survive and then come through this, maybe even with less competition. So a broader sense of quality, we think, makes sense. If you're very constructive and you're talking about U to V, then you do have to think about some of the sectors and factors which have been beaten up quite badly. So for example, value as a factor is at a 50-year valuation gap to the rest of the market. Now, some of that is entirely justified, but eventually you would think that would snap back, and that would snap back as we move from a U to a V shape economic environment. So we are seeing, as Eric mentioned, the last couple of weeks, a few trading days where we've seen this, quality has been less. And by the way, quality, it's not only quality, it's kind of tech defensive and quality, which has done well. So those other sectors have actually done relatively poorly, even in the kind of more recent rally that we've seen. Volatility monetization is an interesting area. So essentially we have volatility that's very high today. It was touching 80, second week of March. It has trended down, but it still remains quite elevated. So the VIX is above 30. It's averaging above 30, between 30 and 40. A lot of investors would have rebalanced, if you like, out of bonds and bought more equities. That's quite a difficult thing to do. If you think of an institutional investor with a corporate sponsor who doesn't have much cash flow, because ultimately who does, that's quite a difficult trade. But if you think about a trade where effectively you're basically being paid, if you like, for assuming equity risk. So in a very simple sense, just writing at the money put options in the S&P. And this is for obviously as a substitute for investors who would normally buy equities. In March, you'd have received a monthly premium in and around 6%. It has fallen since then. It's about 4% today, but that's a monthly upfront premium that you receive. So if you think about an annualized premium, it's very, very substantial. And against that, obviously, you will have potential market volatility and potential losses. So it's not a free ride, but essentially it should provide a more attractive distribution of returns. So less participation at the downside and a better return profile for investors. So standardized, collateralized full vol selling has become more of a focus over the last month or so with investors. And the last point I'd mention is, Eric mentioned it as well, and we saw with the chart from Amazon, trends which have been identified for a long period of time. So trends which could be remote working, education, telemedicine. We were talking about these, for a number of years. Things have accelerated very quickly. So we're all working at home. Your kids are probably in the kitchen working online. Our parents or our relatives are communicating socially on Zoom, and all these other things are happening very, very quickly. In China, in the third quarter of last year, about 25% of digital phone users are now on the 5G network. So adoption of new technology is moving much, much quicker. So kind of thematic sort of investing we think is interesting. Against that, there are some pretty negative themes. So negative themes and structural themes now would be standard retail. So obviously real estate linked to the high street, or real estate linked to prime office space as well in every city, particularly London, New York, and so on. There's question marks about whether if you need a trading floor with 500 people, is that ever going to happen again? I mean, I don't know. I mean, I wouldn't get ahead of it, but essentially you can imagine real estate suffering for quite some time with that headwind when people are thinking about, maybe we're changing the way we work and having greater mobility around that. So quickly, just moving on to dislocation. As I said, just because the markets fell 34% peak to trough in March, obviously recovered quite a bit since then. That doesn't mean it's necessarily a period of dislocation. But we have to bear in mind that when you have global mandated economic inactivity, even if you have some decent fiscal stimulus, it is the case that most medium to small size enterprises struggle, and after a period of time, their doors remain closed. So if you look at the diagram on the bottom left, this shows that if you take, this is a survey of 10,000 small businesses in the United States, you're looking here at about 70% if they would shutter if they didn't have cash coming through over 4 to 6 months. So that is a concern. Now, there could be potential opportunities here in terms of refinancing these businesses, particularly if they're relatively good businesses just being punished by what's happened with COVID. But nevertheless, we are talking about the epicenter of this crisis is going to be felt in small and medium-sized enterprises. 45% of employment in the United States and about half GDP is around small and medium-sized enterprises. So, and obviously that's the largest economy. So this is why I think there's been very deliberate attempts to focus on this space by some of the fiscal authorities globally. So if I was to look at distress today, well, historically distress, when you talk about it, what are the opportunities? Usually when you have a very significant market correction or you have a significant dislocation from a real economy perspective, the investors who have dry powder, who are willing to provide liquidity, can get well compensated. So this could actually turn out to be a strong vintage year for investors. Now, obviously, there are negative marks on what's coming through on private market investments that were made in previous years, but investors tend to invest year in, year out to keep their commitments at a certain level and make sure that works. For selling, you definitely get institutional investors because they need to find liquidity, will go into the market and try and sell more liquid positions. Again, it doesn't happen in the space of a few weeks. It really is dependent upon the duration of the correction that we have here from a real economy perspective. TALF, which was something that was going back to the financial crisis, it's been announced that there's going to be another Federal Reserve directed TALF program on asset-backed securities. We'll see whether that's priced attractively or not. More generally, there could be opportunities on secondary private equity. So discounts could improve. They haven't been particularly high over the last few years, but they could be 10 or 20% if investors are willing to able to provide liquidity. You're getting good transparency in secondaries. You're getting good transparency in co-investments. So you see some level of demand for all of those other things. CLOs, this is the area that got beaten up the most in the correction and then tightening quickly in the space for a few days. You're likely to see a lot more volatility in this space, given the fact that you're going to have more defaults in the coming couple of years. They could still be very money good, but essentially investors have to have staying power when you think about CLOs as an asset class. So the last point I made, the last theme, if you like, idiosyncratic ideas. So thinking about strategies which are not correlated to the general market is positive. Or thinking about things which are deep contrarian could be positive as well. So, examples on correlated strategies. So hedge fund strategies with a low equity beta. So macro short-term trading type strategies could be very good as if you like, if nothing else, a modestly cost insurance policy. Of course, how you implement it may not necessarily be low cost, but one has to think about that versus just simple hedging. And you can think about other things. So if you think about deep contrarian ideas, so commodities, it's a terrible asset class to talk about. Most institutional investors have turned their back on commodity markets some years ago. It doesn't seem to be reflected in strategic asset allocations anymore. But what we should recognize, and we're all CFA holders or members of the society should recognize the fundamental difference between commodities and equity markets is equity markets have the luxury to look 2 or 3 years hence, look at an improvement in earnings and discount from that point, while commodity markets have to clear. So they have to clear on a spot basis. So demand and supply have to clear. So if you have a very significant fall in demand, which is what we've seen, you have to have pricing which reflects that. So you see here back in 2008, the drawdown we saw in gasoline, copper, gold and soy milk, and then you see the recovery thereafter. We're not in a dissimilar situation now where these markets are reflecting that significant fall in demand, but we are seeing better numbers coming out of China. So China, which is the biggest consumer of copper and nickel, you could make an argument that those markets have been beaten up too much, and there could be an opportunity within that. Everything that's happened in the markets today looks quite deflationary. In a year or two from now, we could have an inflation spike. So thinking about inflation and what is a risk mitigation to that inflation, commodities is one of those asset classes that could be interesting. If you think an L shape, if you think we're going to go back to the barter system, then it's about agricultural commodities. If you think it's UV, stronger economy, then it's about industrial and potentially energy-related commodities. Insurance-linked strategies, so just an example, completely off the run strategies, which are not, their performance is not linked to the general economy, is something that investors need to think about as well. So insurance-linked strategies are essentially providing insurance for things like hurricane risk. As you can see in February, this is the ILS index, is up 30 basis points. The market was down 8.2%. You can see insurance companies moving more risk off their balance sheet potentially as this goes on. So pricing can improve in this space. But clearly, a hurricane is not correlated to what happens in general markets. You can definitely have losses in this space. But if you think historically over the last 10, 12 years, this kind of space has generated an average return of about 7% with a couple of years of exception. So it's been a pretty stable source of return and uncorrelated to the wider market. So that's just one example. There are others I could speak about, but it's very important that investors think about these off-market uncorrelated strategies, whether it's kind of short-term trading strategies like macro, or you're talking about more opportunities providing capital where others potentially are not, like insurance. So that's basically the kind of four themes. I'm going to hand this back to Eric, who's going to bring it all together from an allocation perspective.
Great, thanks, Joe. And we're also getting a bunch of questions, which is great. Thank you. I'll work some of your questions into my responses as we try and bring this all together in terms of how we're positioned in portfolios and how we think about these scenarios. So our base case, which we described as the U-shaped scenario, where we still assign a 65% probability to that, and that is how the insights and perspectives around the expected path through that scenario is driving our positioning. So what does that mean to us? In that base case, we are focused on quality within equities. We are focused on companies that can sustain dividends. So these are key elements of those first two themes: durable income and yield, and quality, the new regime in equities. And also we're focused on volatility monetization. So what does that mean on the equity side? We're biased towards larger cap, higher quality stocks in the US, in domiciles that have the greater financial strength, greater fiscal monetary latitude to drive through this crisis. That leads us to a bias towards the US. Frankly, it leads us to be biased towards China and kind of greater China and the economies that are linked to China as we move to a deglobalized and kind of bipolar global system. It leads us to substitute or take on a portion of our equity exposure through equity index put writing to systematically capture that attractive volatility premium that Joe, or insurance premium that Joe described, with writing puts 4% per month. On the fixed income side, we're biased towards quality investment grade and
Eric, you're cutting out again.
Well, so I'll just fill in then. So selective high yield. So as you'd expect, we're an active manager. We think this is the time active managers really earn their fees. So essentially making determinations about, what on a sector by sector basis, what are the right sort of credits. Right. Sorry, I just filled in the gap there.
Oh, good. Okay. Thanks. But I'm back now.
Okay.
Okay, good. And on the alternative side, beginning to allocate additionally to private markets to take advantage of secondary opportunities in private equity, in private credit, and the uncorrelated areas that Joe described. So as part of responding to your questions, one of the questions was around deglobalization. And we do believe that that the post-crisis environment will be characterized by a trend that actually was in place for a number of years. The level of global trade as a percent of GDP growth, the number of deglobalizing actions by governments had been increasing really since the late Obama years, before the current administration in the US. And we think this now accelerates, that as companies need to fortify their supply chains, localize and regionalize their supply chains, as you see increasing kind of conflict around these kinds of issues, we think that deglobalization will continue. That's challenging for components of the emerging markets, for sectors of Europe and Japan that are dependent on trade, on that global growth. Better for areas of the US, certain areas of emerging markets, certain areas of China. As I mentioned, as we show on this page, when we forecast our expected returns given our base bull and bear case scenario, in our base case, better risk-adjusted returns within fixed income than within equity. We got several questions about US versus developed markets, and this really gets to, in our base case, and based on some of the key themes out of the post-crisis environment, we think that Europe and Japan have some challenges relative to the US and kind of greater China going forward, and more resource intensive and less kind of financially flexible components of the emerging markets also face challenges in this environment. And we think that theme continues. So we're currently biased towards the US and greater China in our portfolios, both on the equity and on the debt side. China bonds is actually, in our view, an attractive area of market. In terms of value, growth has continued to outperform. We've positioned to benefit from that. We continue to be biased more towards growth and quality within our equity portfolios. But if we start seeing evidence that we're moving our way through that base case, or evidence from the data, we need to see evidence in the viral protection side, on the pace of reopening, on the impact of stimulus and the magnitude of stimulus being able to be implemented in places like Europe, then we would pivot more to that bull case. And as Joe, if you move ahead to, I think, the next slide, which gives kind of the playbook, across various investment categories, this hopefully answers some of the questions about value versus growth and US versus non-US. This is our attempt to frame kind of broad investment strategies in terms of which scenarios they will benefit, or which themes they will benefit from across equity, fixed income, and alternatives. And you see that in the base case and the bear case, you want to keep leaning into quality. You want to begin to take advantage of dislocation that will emerge later in the cycle. In that bull case, that's where we would see the bigger rebound from value. We're starting to see some evidence of that in markets right now. We're not quite there yet in terms of being willing to fully pivot, but what we are doing is we are beginning to allocate towards higher quality exposures, say within small cap stocks, or we're looking at allocating to Japan, which as a cyclical economy, we think will come out of this more strongly than areas of emerging markets, for example, given Japan's greater kind of fiscal and monetary flexibility and ability to act in unison from a policy standpoint. And also, we believe, and this was one of the questions around central banks and the low yield environment, we believe that as we set out front, regardless of which path we're following, it is likely that central banks remain lower for longer, and in this case, much lower for much longer. US, the Fed funds at zero, negative rates in core Europe and Japan for likely years to come. And that leads us to the importance of that durable income and yield theme leads us to, find attractive various areas of credit and multi-asset income strategies, which Joe and I lead. And then also in the dislocation area, where you can pick up attractive assets that have significant yields or cash distributions at very interesting valuations if you're able to be a liquidity provider in this environment. So that's a response to a number of questions. Let's see, John, Joe, other questions, comments, thoughts?
So I'm just looking through. I mean, let's see, we've got a question on CLOs and default rates. Either of you care to hazard a guess? Europe and the US?
Sure. So in the U.S., we are expecting our base case assumes 10% defaults and kind of across the high yield complex, both nominals, high yield nominal bonds and bank loans. In the bull case, that's 8%. In the bear case, that's 12%. 10% kind of annualized default levels imply 30 to 40% defaults over a 3 to 4 year time period, which is really the duration of those markets. That's a pretty severe shock. In terms of, that's our expectation. In terms of what's priced right now, U.S. high yields, the high yield is pricing about 8% default rates. So spreads are looking like they're either fully pricing in defaults or maybe even a little optimistic around defaults, which is why we're still being a little cautious in terms of risk taking. Now, that said, what we've seen is a significant divergence in bifurcation in markets. And so you see, and this is a bit of an exaggeration, but it's directionally correct. You see 80% of the market pricing at par and 20% of the market pricing at default. And it's so that the market has really market price setters have really kind of bifurcated between what they view as the credits that will survive and credits that won't. And we think that there's opportunity around both of those sets. When you translate that into CLO default expectations, we look back at the history of BB CLOs, and as long as there have been CLOs, the entire history of BBs, there has been a 1% total default rate of BB CLO tranches, and that's so roughly 10 basis points a year. So the above the equity layer in CLOs, the credit protection is such that it is extraordinarily unlikely that we will see major impairment of mezzanine tranches of CLOs where we see great opportunity. That said, we could see additional pricing pressure because while we don't expect there to be major damages in terms of default, we do expect further downgrades, that it is likely that we will get additional waves of downgrades in CLO tranches based on the level of downgrades in underlying paper. Downgrades as opposed to defaults. So, we think that there's risk of short-term pricing pressure still in CLOs, and yet we see pretty attractive entry points and opportunities in the space if you can lock up some capital and take a longer term horizon. This could be a pretty interesting entry point over the coming months.
Great, thanks, Eric. Just one more question, I think. So this is a big one, how do you hedge for geopolitical risk considering we are long US and China?
Well, risk hedging is always challenging. We actually think that U.S. Treasuries still represent an interesting hedge. Yes, yields have come way down, but U.S. Treasuries still have the highest yield of any major developed economy. 10-year Treasury at 0.6, 0.7, the long Treasury at 1.3, 1.4%. In a very negative scenario, even a negative geopolitical risk scenario between U.S. and China, it is likely that Treasuries will still be a very good hedge, that you will see a decline in rates from Treasuries, and that they both have a positive risk premium now, and they can still hedge in extreme environments. And so we're continuing to include those. we're also looking at diversification into areas like tips and linkers, which have some of the same attributes of treasuries, but are very cheap right now, and elements of the commodities complex can represent some interesting hedging exposure. And then finally, just diversification into non-correlated investment categories. So insurance-linked securities, the types of active strategies that Joe described, which should be, should deliver results without correlation to major markets. So uncorrelated active strategies. All of those can help, manage portfolio risk in a geopolitical kind of shock environment.
Okay, thanks, Eric. If Niall permits me, there's one more question that I think might be interesting. How do you use derivatives within your portfolio?
Joe, do you want to take a whack at that, or?
Well, I think I suppose we use derivatives from a standard portfolio rebalancing efficiency perspective. So that's what we use them for. Sometimes we may have a client who's given us a liability benchmark, so we use derivatives in order to be conscious of that. We will use derivatives as part of the return engine if it's appropriate. So, for example, put writing, we would use exchange traded options to express that. But generally speaking, we prefer to kind of use derivatives for just improving the efficiency of the overall portfolio, as opposed to really expressing a return dimension to it.
Great, thanks, Joe. So Niall, I'm going to hand it back to you. I think we're over the hour mark at this point.
Thanks very much, John. Yeah, I think we're just over, but I think the volume of the questions and the quality of the content really is really what drove us. So that's great. John, Joe, Eric, really want to thank you very much for a great presentation, very thorough and a great holistic view of the current market environment. So thanks very much on behalf of the CFA Society of Ireland members. That's all for this. Thanks. That's all we have time for this month. Please keep tuned to the CFA Ireland's email distribution. We will be giving you notice of any upcoming webinars, and we're going to keep rolling out, high quality content so that you can keep up to date with your CPD requirements and keeping, good market interpretation content for you to consume. Thanks all, and have a good evening, and please stay safe and well in these times.
Thank you.